But with the US Treasury's plans to convert to gold and the global central bank's de-dollarization of sovereign institutions heating up, the long bond yield will eventually rise above 5%. This is considered the tipping point where the Fed will most likely start controlling the yield curve, flooding the market with cheap money and buying gold to hedge. With the US purchasing less gold than the global central bank and the US Treasury owning only 8,100 tons of empirically rehypothesized gold, all signs point to a forced revaluation of gold based on cash. Buying back leased gold reserves will now have to be done at market prices as the LBMA-CME has become price takers. This conservatively restates our end-of-year minimum goal of $4,500. Andrew Maguire has made it plain that the current dynamics of the gold market show how the public narratives and private actions of Wall Street are frequently at conflict with one another. Just recently, financial institutions were making headlines by speculating that gold prices could drop to $2,600 or lower, while their own trading desks were secretly setting up for higher prices. Institutions were quietly planning for a reversal of course and shutting down derivative bets as they warned investors of downside risk. According to him, this indicates that the derivatives market is unable to control the shift in physical market demand, which in turn threatens the long-standing tactic of suppressing gold prices through paper. The COMEX and LBMA systems' fundamental flaws are now coming to light. With dwindling chips on the table or open interest, the Federal Reserve, the only major bank still relying on short holdings, is unable to keep its grip on the gold market. It has become more and more difficult to maintain the illusion due to arbitrage opportunities between suppressed paper pricing in the West and rising physical premiums in Asia. Maguire notes that trust in the Western system is dwindling due to the inefficiency of converting huge London bars into the kilobars needed by Asia and the constant transfer of unallocated contracts into allocated physical holdings. When liquidity sources go out, the COMEX and LBMA system will have to face the fact that physical markets, not paper markets, determine the real global gold price. Policymakers are left with limited space for maneuvering as a result of this unraveling. Compliance with the requirement to cover short positions at higher prices has already been achieved by the Bank for International Settlements, and the Federal Reserve is being pushed to do the same. The reality that many of these paper contracts were never supported by actual bullion is being revealed by delivery demands. Now that we've seen record physical offtake and largest deliveries ever, time is of the essence. According to Maguire, the Federal Reserve will have to give up on short derivatives and accept a reassessment of gold at some point. This might cause prices to go closer to $4,500 as physical markets take back control. To ensure you don't miss a moment when reality meets market, subscribe and push the bell symbol before we get into Andrew's perceptive thoughts from his most recent chat with Mario Ineco. All right, let's dive in. By the way, this is the same bank that we exposed alongside JP Morgan when we were quietly winding down the Federal Reserve's 5-year OCC derivative bets. Keep in mind the officer controller bets. They are issued only 4 times a year. This gives the lads a chance to relax and enjoy themselves before the book is published. But we managed to get it. Everything comes down to the fact that the US Treasury is getting set to revalue its gold reserves, making it the only central bank that is still short gold. A lot of people are skeptical, that much is clear to me. Everything is coming to a head. We will examine it again soon, but the clues are already there, as we have been pointing out. Our analysis that the LBMA COMEX has outlived its usefulness is increasingly gaining traction nationally. That being said, let's take a look at the August CME LBMA footprints. These reveal, following Trump's tariff tantrum, how diminishing COMEX open interest has become. In other words, no one wants to trade the chips anymore. Since the Fed is the sole remaining central bank attempting to limit, it is imposing discipline on them. Gold's price relative to the dollar. For such, they rely on the COMEX. The problem is that there aren't enough performers. The Trump tariff tantrum revealed the huge structural disparity between the Western gold market infrastructure and the Asian demand for 1 kilobars, as well as the price mismatches between Western paper-derived prices and physical pricing. This is in addition to the issues with the inefficiency of refining 400-ounce London bars. The remaining COMEX open interest, or chips in the casino, according to liquidated suppliers, aren't enough to control enough positions to keep the COMEX-centric paper gold price manipulation going. Global central banks, sovereign wealth funds, and institutional buyers are taking advantage of the Fed's now obvious efforts to lower prices by dropping formal bids on the COMEX within the next day or month. As a result of these physically transferable assets, the Federal Reserve is finding it harder and harder to short cover its leased bullion borrowings without further depleting its reserves. Right up until the end of the month, the Bank of International Settlements had to square the OCC bets at an all-time high price point. Plus, the global gold price is now determined by physical market liquidity, so the Fed will have to swiftly abandon its short derivative strategy and join the gold revaluation process. The Fed is expected to follow the BIS in becoming Basel III NSFR compliant, according to feedback from all physical liquidity providers. This is where the BIS short fell and what transpired, so keep that in mind. Furthermore, the Fed is currently in a situation where it must engage in short covering. What the BIS done must be followed. Additionally, it is anticipated that the December contract, which was recently launched, will likely have to be implemented. The first notice will be given on November 27th, and delivery will begin on November 28th. This contract reflects the COMEX liquidity. Therefore, this agreement will remain in effect until November. Our guess is that our spot, 4,500 goal, will be more accurately reflected in the pricing. Slicing through the final 3 weeks of the most precarious European holiday, the liquidity was at an all-time low. Right now, this tariff tantrum has shown how urgent it is to resolve the LBMA-CME cartel's paper-to-physical gap. Full physical gold allocations have replaced high counterparty risk unallocated contracts, according to liquidity providers, who have seen the biggest outflow of LBMA-CME hedging volumes. So that's the deal. Eventually, the Fed Ron cartel will be forced to embrace full Basel III compliance or risk becoming obsolete as a gold trading hub due to the drain of leveraged unallocated LBMA gold into fully paid up physical vaults beyond the cartel's ring gate. When we say they must have the physical to support these claims, we mean they must comply with Basel III. As we delve further, we find the footsteps, step by step. And as we discussed in the previous episode, it was the biggest in history, coming after the August gold loadout, which was technically not a delivery month, but rather a futures month that wasn't meant to be one. The 28th of August was the last day to contractually deliver or fold your position. Thus, we expected any remaining undelivered paper warrants to be forced into delivery by first notice. Additionally, as we have previously mentioned, in physically settled markets, the settlement date for called for delivery gold is T+1, which is clearly worse than in many futures markets, or I should say physical markets, where the settlement date is T+0. In these markets, it takes 1 day to physically deliver a fully paid up bullion bar. Since that is in line with Basel III compliance, it should be considered the worst case scenario. Large institutional investors and sovereign pension funds are making a subtle but calculated move, which is having a big bullish impact on the gold market. There have been rumors that large Chinese pension funds are being told to boost their gold holdings from 1% to significantly larger amounts in the next years. These funds handle trillions of dollars worth of assets. A large portion of the world's yearly supply, hundreds of tons, was added to demand even at the beginning of this mandate when gold was trading near $2,700. The fact that gold has gained roughly $900 per ounce since then shows how rapidly these fundamental reallocations are having an effect. The demand for gold could outstrip supply if these allocations keep growing, especially among BRICS states. There is a global trend, not just in China. Similar changes are being considered in India, which may attract tens of thousands of tons of extra demand each year if its massive $177 billion pension system were to invest in gold ETFs. The BIS's reclassification of gold as a top-tier reserve asset and the 2022 freezing of Russian assets prompted central banks in Asia and the Middle East to speed up their purchases. A larger tendency towards de-dollarization is seen in these actions. If sovereign borrowers decide not to use US Treasury bonds in favor of precious metals and other alternatives, shifting the very basis of international finance. Market prices do not yet represent the entire extent of central bank stockpiling, which liquidity providers believe may be tens of thousands of tons higher when unreported movements through intricate trade pathways are considered. That feedback is undeniably trustworthy now. Gold was worth around 8 million ounces, or $2,700, when the mandate was first introduced. 1/4 of a 3,000-ton supply was used up. At $3,500 an ounce, gold has increased in value by about $900 since this directive. Now, this schedule is still a mystery, but with the BRICS trade war heating up and the military tensions rising, an extra 1,000 tons would be a significant increase. By the year 2026, demand might reach 1/3 of the world's supply. We anticipate making an announcement regarding this soon because the input has been incredibly reliable. Another development that could lead to an extra 17 tons of demand is that India's market regulator is contemplating approving the country's $177 billion pension system to purchase gold ETFs, just a 1% distribution. This is in line with what is also empirically apparent across the entire BRICS realm, and it follows the Bank of India's decision to convert US Treasuries into gold immediately after the BIS reclassified FX gold as a first-year high-quality liquid asset on January 1st, 2023. Also, sovereign borrowers are moving their debt from the US dollar to the lower interest Swiss and Chinese markets. Investors from Asia and the Middle East are staying away from the United States. Unreported central bank gold purchases have also made it to the Financial Times via Goldman's desk. Since the freezing of Russian assets in February 2022, our liquidity suppliers have been reporting this. The fact that physical gold buying had certainly accelerated when the Bank of International squared all their remaining 500 tons of gold swaps is fascinating, but I think a lot of people knew this was happening. That was on November 1st, 2022, in case you forgot. That was right before January 1st, 2023, when the BIS reclassified gold as a first-year high-quality liquid asset. As a point of reference, when factoring in direct door bar imports, which mysteriously vanish into the 42 district Chinese customs districts, which feed into a 678 local customs matrix, the net effect on the paper market is dilution. Additionally, we have previously discussed the fact that a great deal is lost due to this system. We also suspect that this is a covert military hold. In addition, if we limit ourselves to analyzing actual worldwide supply and demand, these liquidity providers have come to the conclusion that the true, unreported demand for gold from central banks, which is not even included in Goldman's estimate, is closer to 42,000 tons. We have not yet factored this in, but it aligns with our $4,500 goal for the end of the year. Clearly, the White House is aware of and reacting to these gold for treasuries swaps. The recent summit between India, China, and Russia, which was bullish for gold, will have irritated the White House, leading to a surge in demand for critical mineral silver and new supplies of safe haven gold, which will put pressure on the dollar. To be more specific, the White House is pushing back against such pushbacks. As these incredibly optimistic occurrences unfold, we will provide further updates. But with the US Treasury to gold conversion process and global central banks' efforts to de-dollarize the economy heating up, the long bond yield will eventually rise above 5%. This is considered the tipping point where the yield curve will most likely be controlled, resulting in a flood of cheap money into the market that will be hedged. Gold purchases by central banks around the world. Everything leads to a forced revaluation of gold due to cash settlement, given the US is behind other global central banks in purchasing gold, and the US government holds just 8,100 odd tons of empirically rehypothecated gold. Buying back leased gold reserves will now have to be done at market prices, as the LBMACME has become price takers. On the one hand, this restates. Aim for at least 4,500 by year's end. This demand wave will have far-reaching consequences in the future. The sudden and official acceptance of gold by sovereign wealth funds and pension systems around the world as a reserve asset has the potential to send prices soaring far above their present objectives. The market might be compelled to undergo a reassessment, where physical demand is used as the standard, due to supply constraints and the declining credibility of paper-based pricing systems. Stainless steel. Due to its narrow market and dual industrial monetary function, frequently neglected but strongly tied to gold's monetary role, could undergo an even greater repricing. In the event that these developments materialize as predicted, a paradigm change may be about to occur where gold and silver once again become cornerstones of the monetary system, posing a serious threat to the supremacy of fiat currencies. That concludes our sessions for the day. Use the space below to share your opinions. Please consider subscribing to our channel and enabling notifications so you never miss an instructional video. Watch this video, and we'll see you later.